Okay, so we are ready to pick back up in Chapter 10. We kind of left off at payroll tax. So let me find the slide where we're at. Okay. Okay, so picking back up where we left off on the PowerPoint, we had just covered journalizing the employee payroll. So this was kind of like the journal entry we did and we did a practice on, where we were looking at, we debit like salaries expense for the gross pay. So like their salary, their total salary. And then we credit all the payable accounts for all the deductions that are withheld from their paycheck. So then we take gross amount minus all of those deductions to get salaries payable, which is the net pay. So just as kind of a review, picking up there. So gross pay gets debited as a salaries expense, and then all of the deductions, just as a review, you can kind of see up here what the employee is responsible for paying. So the employee always pays federal income tax. They would also pay state income tax in states that have a state income tax, like here in Oklahoma. They're going to pay Social Security and Medicare. Those are those Federal Insurance Contribution Act, FICA withholdings. And so those are the four that are required, again, if the state withholds income tax. And then we have any like voluntary deductions. So 401k or retirement contributions, charitable donations, any flex accounts or anything else that they volunteer. If they had like a wage garnishment, that would also be here. So that's just kind of a review of what that journal entry looks like. And then the next one we're going to move into is the employer tax. Okay, so the employee has to pay federal income tax, state income tax, FICA, Medicare, and Social Security. The employer is responsible for different taxes. Okay, the employer is going to pay FICA, both Medicare and Social Security, on all the employees as well, the same percentages. Okay, so the employer is going to pay that. And then in addition, the only other employer taxes are unemployment. Okay, so in addition to what comes out of the employee's paycheck, the employer is also responsible for paying taxes.
What's the difference between a federal unemployment tax and a state unemployment tax?
Okay, so there's two different programs with unemployment. So federal is usually, we pay in, or all employers pay into federal unemployment. And federal unemployment just kind of sets up the unemployment program. Okay, so that's why usually a small amount goes to federal. Most of our unemployment taxes go to the state, because the state's the one that, if we had unemployment payouts, you know, that they're the ones covering that. Okay. So yeah, it's a good question. So that's why you see, like, for state unemployment, our tax is 5.4%, and then the federal is only 0.8%. All total, like, again, we won't get into it too much in here. We're not going to get in too much into payroll, but what happens is the actual federal unemployment tax is like 6.2%, I think. And so if we pay into state, we get like a credit. So that lowers our federal unemployment to the 0.8 instead of the 6.2. So all total, we're paying 6.2% into unemployment. But as long as we're paying state, which we should, all states have unemployment. So as long as we're paying the state unemployment tax, then we get a credit towards it. So you'll always see a small amount federal unemployment, because again, that's just going to establish the federal guidelines and have someone overseeing and run the unemployment program. State unemployment tax, in here they're going to give you that amount, but just know, for funsies, I guess. State unemployment actually varies widely. It can vary state by state. It can vary company by company. If we have what we call a high unemployment rate in the company, their unemployment, rate goes up too. So if we have a lot of claims in a company, or if we don't pay our taxes on time, there's lots of things that kind of impact how that rate is given. So if we have a low unemployment, a lot of times we'll actually pay a lower tax. You can kind of have a good standing credit, basically. So the employer, again, they're going to pay the FICA, Social Security, and Medicare on every employee, just like what comes out of the employee's paycheck. Okay, yes?
You're saying that if their company has like a lot of turnover rates, they actually can have to pay more into the unemployment?
Yes, they can. It depends, like every state has their own guidelines on how they get like an unemployment tax rate. And so usually it'll be based on like claims amounts and pay history. You know, like if you're in good standing and you pay every month on time, you might get a little credit. Or if you have low unemployment at your place of business, you'll probably get a lower credit. So yeah, it's all different. Every state is different though. So every state can have a beginning rate that's different, and then they can all have all these credits.
So the unemployment would be like if I fired XYZ employees versus them just quitting on me? Or at least two
Right,
separate?
yeah. Unemployment is when you're like laid off, basically. And they can deny your unemployment. Like if you were fired for theft or something, your unemployment, it still has to go through the company. The company has to approve it. So like the company can say, oh, they were fired for theft, and like deny the unemployment benefits. So it depends on the standards and the company, you know, the rules of the company and the state. There's different state rules. But yeah, most of the time it's when you're made redundant or laid off, or, you know, you could still get fired and claim unemployment, and some companies just approve it. Depends on the size of the company. Yeah, there's a lot of factors that go into unemployment. So it's a whole it's a whole other can of worms. But yeah, just know, I mean, you won't have to really know for this class, but you know, the state is the one that's responsible though for paying those unemployment wages. So from the employer side, they're going to pay payroll taxes, and it's just these four. Okay. So the employment payroll was the first journal entry. The second journal entry we do is employer payroll taxes. Okay, so these are all tax liabilities that we pay. So Social Security and Medicare, just the same as the employee, and then the employer is responsible for paying state and federal unemployment tax. Now, we don't pay unemployment on all of our wages. Okay, usually I believe it's like the first 8,000 of wages that every employee earns that we pay this unemployment on. Okay, so we're not paying unemployment taxes the whole year, just on like the first 8,000, I think is what it is for each employee. So again, they'll just tell you the percentages and everything though, make it easier. So this is what the journal entry looks like. We're going to have a payroll tax expense, and we're just going to add up those four taxes that we owe. So they calculated them in the previous slide. So again, those are just payable accounts: Social Security payable, Medicare payable, state and federal unemployment tax payable. So we add those four up, and that's our debit to payroll tax expense. Okay. So whenever we have employees, there's always two journal entries as far as payroll. Okay, we have the actual payroll where we're cutting their paycheck, and then we have the payroll tax liability for the employer. Okay. All total, again, the employer is the one holding all of these payable accounts, and the employer is the one that's responsible for sending all of these tax liabilities, or just liabilities in general, to the proper place. So they're going to send, you know, a check to the Social Security office for all the Social Security taxes collected, and then to the Medicare, and then federal income tax, state income, you know, everywhere, health insurance, whatever we're collecting. Okay. So it's the employer's responsibility for withholding that and then paying the proper authority. Okay. That's why we put them all as payables, because we're just taking, you know, we're adding it up at this point. We're journalizing the expense of having the payroll. And then when we pay all of these, we're just going to debit the payables and credit cash. Okay, we're just, you know, sending money. And again, we won't get into it in here, but in payroll tax, we do get into it more. But, you know, it depends on the size of our company and all of that, as far as like how big our payroll is, how often we send in these payments, you know, to like the federal income, like the IRS, for example. Sometimes it's quarterly, sometimes it's monthly. The bigger our company is, the more frequently we send in money to the IRS, right? Makes sense. Okay. So usually we know in this day and age, most of payroll is paid by electronic funds transfer. You know, you set up that automatic check deposit, and those payments are deposited into bank accounts. There could still be some people that are receiving physical printed paychecks, so we can also still do that. But that's pretty much it on that, paying payroll. The only other thing is we usually use a separate payroll bank account for payroll. So we move money into it, we pay it every month. That way we can just, it's easier to reconcile our bank statements.
Are public trade companies required to do electronic checks?
I don't think there's any requirement. I mean, that'll be a company-wide probably, like companies can say that their policy is that it's electronic checks, which I think is kind of more of the norm now, that employers require you to have a bank account and have, the direct deposit set up. But I think a lot of places, they still have the option of the paper check. It's definitely not a requirement, but most people prefer it that way. It's easier. Yes?
On the unemployment tax payable, why do they only consider those percentages on that smaller?
Let's see.
There's like a cap.
Oh, yeah, with the federal and state unemployment, it doesn't really talk about it in here. Well, it does kind of show you. It doesn't talk about it, but it shows you, yeah. So, like, usually we only pay unemployment up to, like, the first 8,000 wages for each employee. So once we've paid an employee $8,000, we no longer take out unemployment, or we no longer pay unemployment. So that's why here, like, 25,000 wages were subject to FICA, Social Security, and Medicare, and only 10,000 was subject. That's for the whole payroll, so that's like multiple employees for that pay period. But yeah, good question. So they'll usually tell you, like, oh.
So that's if like a worker was laid off and they filed for unemployment, and then they only earn that number back, like that $10,000.
No, this is all the employer's contribution. Unemployment is calculated based on federal and state guidelines. So it's usually like a certain percentage of your take-home pay or your net pay that they calculate. So then they just won't receive it. They don't have to. No one's required to file for unemployment. The employer's just required to pay in to the unemployment program, to the state program.
So it's just like putting in like money and stuff. It's not
Yeah.
just for that person.
Right, exactly. Yeah, they're not putting in unemployment for like you specifically. They're just putting in, it's just like Social Security. So like we all contribute to Social Security, and then when we're eligible, we can draw on it, out of the big, yeah. Mm-hmm. Good question. No. Any other questions on payroll taxes so far? Okay, well, let's do an example. We had done one last week on the employee payroll. So I'm going to go back into that Chapter 10 practice. And we'll do an example on employer payroll tax liability. So we are on number 4, the BE 10-4. Okay. Bigger. Okay. So again, this is just an example of the employer payroll tax liability. So again, from the employer standpoint, we're paying payroll taxes. We're paying FICA, Medicare, FICA, Social Security, and federal and state unemployment. So those are the 4 taxes, payroll taxes, that the employer is responsible for. It says the payroll register of Heritage Company indicates $3,900 of Social Security withheld and $975 of Medicare tax withheld on total salaries of $65,000 for the period. So they've just given us the FICA taxes. Earnings of $10,000 are subject to state and federal unemployment. The federal rate is 0.8% and the state rate is 5.4%. So it wants us to do the journal entry for the payroll tax expense, okay? So again, on your homework or on the test, if you see, they may give you, other calculations, other withholding amounts like federal or state income tax. The employer tax liability is only FICA, Medicare, FICA, Social Security, and your state and federal unemployment. So on the employer tax liability, there's just those 4 taxes that we always pay, okay? So the total amount we're going to debit to payroll tax expense, but we don't know that amount yet because we have to add up the 4 taxes. So I'm just going to put in that debit payroll tax expense. Then they told us what our Social Security was. So on the next line, I'm just going to do Social Security tax payable. And they gave that to us. It was $3,900. $3,900 of Social Security tax payable. And they gave us the Medicare amount too. So under Medicare tax payable, they told us it was $975. So Medicare tax payable is $975. These are the same amounts that were withheld from the employees' paychecks. They are all paying the same Social Security and Medicare. And then the last 2 again is federal and state unemployment. So we have state, I believe is the one they give us first. State unemployment tax payable. State unemployment tax payable. And how much is the state unemployment tax payable for this pay period?
5.4.
Yeah, 5.4% of $10,000. So how much will we owe? $540. Good. So we took $10,000 times 5.4%, $540. And then last but not least, we have the federal unemployment tax payable, which is 0.8%. So how much will we pay into federal unemployment? $80. Okay, $80. So our total payroll tax expense, we would add those 4 up. So what's our debit to payroll tax expense? Very good, $5,495. $5,495. Okay. Any questions on that one? So when you're doing payroll, just remember there's 2 journal entries, the employee pay and then the employer payroll tax expense. Okay. All right. That one's a pretty easy example. I'm going to go back into the PowerPoint, and the last thing we're going to cover in this chapter is the installment notes. And then we're done. Let's see. We're not going into that. We talked about those things. Okay. So I know I mentioned this on Thursday, but installment notes are another liability that we can have. Installment notes a lot of times both have current and long-term liability attributes, because an installment note would be a note payable that we have that we take out maybe on a car payment or equipment or whatnot that's more than the current year. We might be paying for 5 years. It could be a mortgage note, so it could be 20 or 30 years. So basically what we're looking at is the characteristics of an installment note are it's the same equal payment every payment that we make. It could be yearly payments. We could have a loan that we took out and we made 5 yearly payments, which sounds kind of rough, right? Or it could be like monthly payments like we typically have for mortgage or car payments. But the attributes, again, are your payment amount is the same every month or every year or whatever. It's equal payments. But we know if you've ever looked at your car note and how you're paying it, or even looked at, I log into my bank and can see a different amount is going towards the principal balance and the interest every time you make a payment. So, when we were doing current notes payable, we just calculated total interest because we had one payment, right? So we just calculated interest based on days, and we had a payment, principal plus interest. With an installment note, your principal and interest is going to change with every payment. You know, as we pay down the principal, the interest that we pay goes down because we're recalculating interest on the new balance, okay? So if you've ever looked at like a loan amortization schedule, and we can actually create one in Excel, it's really fun. Super fun, right? You can see, you know, over time as you make payments towards that car, your principal amount is going down, and so your interest, you know, you have more going to principal and less going to interest over time. So that's an example of an installment note. So we're going to learn how to like calculate, well, how much goes to principal? How much goes to interest? Okay. And then by the end of the note, we should have paid the full principal balance and all the interest. The good thing is, if you do take out an installment note, a lot of times they have clauses in where there's no early payment penalty. What that means is if I want to make extra payments, you know, to reduce my interest over time and reduce the amount of time I am paying on this loan, I can do that. So for instance, like, I know I told you I have a minivan, so we took out that note. Right now, my husband also has a car payment because we'd both bought vehicles right before we met. So he still has a car payment, but his will be, I think, paid off next year. So once his is paid off, I'm going to take what we were paying towards his car payment and put it towards the van. That way we can pay it off quicker and reduce our interest. So I can do that and then maybe take a year off of my payment. I think I calculated like 18 months off. So woohoo. And that's some saved interest. Now it's a low interest rate, but I mean, any amount of saved money is good. And plus we pay off the loan earlier. From a business standpoint, that's good. Not only are we saving interest, but we're freeing up capital, right? So then we can invest in new assets. So, and that's the same personally, you know, then he can get a new car, hopefully, you know, in the next 4 years. So he doesn't have to drive the same car for 80 years. So, you know, that's kind of the same plan for a company. So a lot of times they'll set up an installment note loan, but then they may pay it off early. So not only are they saving on interest, but they can also then free up some capital to invest in new assets. Yes.
What are some, you're talking about an early payment penalty?
Mm-hmm.
Like what type of notes have those, or what type of?
Any loan can have an early payment penalty, but I can't remember. I haven't seen one in years, honestly. Most loans now are geared where it'll be when you sign the loan contract, it'll state you can make extra payments or you can pay the principal off at any time without penalty. So you just want to make sure that's in the loan document, in the contract, because some will actually charge you if you pay it off early because they're not recouping the interest, you know, but most of the time, the only loans that I've actually seen like that are like payday loans, you know, where they're like, oh, you can take out this $1,000 at like 500% interest. Yeah, I'm exaggerating, but not much if you've ever had a payday loan. And, you know, they'll say, oh, it doesn't matter if you pay today or on the 15th when it's due, you're going to pay the full interest. Yeah. Yes, ma'am.
I was looking to pay off my car through Capital One,
Uh-huh.
and I owe like $1,500 something like that. Crazy. And the fee for paying it off, like $200.
Isn't that ridiculous? So yeah, sometimes there is a fee associated with it. So, and then you don't really think about it when you're signing the loan. So yeah, be careful. Sometimes there are fees associated with it. So depending on who you finance through. So I always look at that, you know, when you're taking out a loan to make sure there's no early payment penalty. Because that's unfortunate. You're like, oh, I'm ready to pay it off. I'm going to save money. Well, it may not be worth it. You probably don't pay $200 in interest over the rest of that $1,500. So, you know, you have to look at, oh, okay, is it really worth paying that penalty then? So, yeah. So just be careful on those. You know, look for early payment penalties or fees. Things you don't really think about, right? You just think, oh, I can pay my loan off at any time. It's my loan. I pay it, and I'm good. So, yeah, it's kind of interesting. So we're going to look at calculating an installment note. So again, usually what we have with an installment note is what we owe in the current year will be a current liability. And then, you know, if we take out a 5-year note, the first year will be current, and then years 2 through 5, bless you, will be listed as a long-term liability. So installment notes generally a lot of times have like both a current and long-term debt associated with them. A lot of times we call, installment notes are usually like ones where we're taking out a note for a car or equipment or a mortgage or something like that. So there's usually some asset tied to it. So basically, they still have a lien against that asset. You've probably heard the term lien before. So if we don't pay the note on time, for several months, then they can seize it, and that financing company will own that asset. Okay. Usually called like secured debt. So when an installment note is issued, if we're actually borrowing cash, then we would debit cash and credit notes payable. So it's still a note, still a notes payable. It may just be, a different type. We could be debiting like equipment or something like that too. Okay, so let's look at one. To illustrate, January 1st of year one, Lewis Company issued the following installment note to Citibank. So we have a principal amount of the note is $24,000. The interest rate is 6%. This is a term of note is 5 years. And this is one where we're just making one annual payment every year. And they've already calculated the payment, which that's really just you can do that with like a scientific calculator or Excel, use the payment function. You can calculate payments based on the term and the interest rate. It's a payment, it's equal PMT, and then you put in, we'll look at it later just for fun. It's so much easier in Excel. So you can calculate the annual payment. But the entry to record that is the same entry of any note, short, long term, doesn't matter. It's still a note payable. So cash is debited and notes payable is credited, okay, when the note is issued. Then every time we pay it, we're going to make a payment of $5,698. That begins December 31st of the first year, and we're going to do that for each of the 5 years. But every time we make a payment, we know we're going to credit cash, the $56.98, but what we debit is going to change because the amount that we're paying towards the principal and interest is going to change. So here's what they call it allocation of periodic payments. Another term is an amortization chart. So you might have heard that again. So right here is showing how much we owe, the $24,000. We paid $56.98 as of December 31st. So we calculate interest by taking the principal amount times the interest rate. This one's annual, so we can just take it by the 6% because it's an annual interest rate. If we were paying this monthly, we would want to divide that interest rate by 12 to get a monthly interest rate. Okay, but here it's an annual rate, so we just take 24,000 times 6%. So the interest expense or the charge of having this note in year one was $1,440. Well, to get how much we're paying in principal, we just take the total payment that we're making minus that interest expense. And that's how much is going towards the principal or the full amount. Okay, so that's D, the decrease in notes payable. So in year one, we had $1,440 go to interest and $4,258 go to the actual note itself, the principal balance. So then the carrying amount, or what I would refer to as what we still owe, we just took 24,000 minus the decrease in notes payable. Okay, so at the end of year one, we still owe $19,742, which that's where we start in year two. And we do the exact same thing. Payment stays the same. We take 6% of the carrying value for the amount owed. We get a new interest expense. Notice it's lower because we owe less. And then we subtract again. We take the $19,742 minus the interest to get the amount. I'm sorry, not that. That's the carrying amount. The payment minus the interest to get the decrease in principal. And then we take the carrying amount minus the decrease in notes payable to get the new carrying amount. So this chart's pretty nice because it tells you, what they did, all the calculations. Okay, at the end of year 5, you'll notice, we no longer owe anything. Okay. And they did round the interest in the last year. But yeah, in the last year we only had $324 in interest, and we paid off the remaining carrying amount. So see, you can see here, we're paying off the remaining carrying amount. So then we see over time, we've paid a total of $4,490 in interest. So the total cash paid was the principal of $24,000 plus all of that interest. Okay, and that's over the 5 years. Do you have a question?
Where did they get that note payment from? Is that given?
Yes, they gave us the note payment. So they told us what the yearly payment would be. And then everything else is just a calculation based off of the principal amount and that first payment.
And isn't there like a trick on the, what is it, amortization? Like say you have a 30-year mortgage.
Uh-huh.
I had a friend once tell me, flip all the way to that 30-year breakdown and pay that additional interest rate and you'll pay it off a lot faster.
You mean like pay off like
Yeah,
the total
you take the
accumulated
$698
interest?
and then
Or
just add whatever that interest they're gonna charge you for to
Uh-huh.
that payment, and it'll just knock your interest down so that you're just paying principal towards the end of your.
Yeah, you can do that. I mean, you're always going to pay some amount of interest, you know, because
Yeah.
until the end, but you will pay less interest over time. You're paying more interest. You can pay interest up front sometimes, yeah. So it'll be, you know, your principal will go down faster, so you'll pay less interest over time. So you will save yourself a lot of interest. Yeah. I don't think you could ever, yeah, you can't do away with it, but it can knock a lot of it off, though. Yeah, it's pretty nice. Let's see. So this is what a journal entry looks like in year one when we make the first installment note payment. So we have the interest expense, which we already calculated, and then the notes payable is going down that $42.58. So that's the reduction in principal or reduction in the carrying amount. And then the cash was always the full payment amount. Okay. So again, your interest expense and notes payable reduction will change in years 2 through 5, but your cash payment stays the same. There it is in year 2. As you can see, the interest goes down a little, so what we pay towards principal increases, and then they show us year 5 as well.
So we keep subtracting then.
Yes, yeah, we just keep subtracting to calculate our new carrying amount and then calculate our new interest expense. So when we have finished paying after 5 years, the carrying amount should be 0. We've paid off the full amount plus all the interest, and so we are finished. Let's switch over and do an example in Cengage. It's our last one. Do it. It's not too bad. It looks longer than it really is. It won't take that long. It's just some math. So they're going to give us this amortization table, and we're going to calculate it just like what we saw on the previous example. So on January 1 of year 1, Bryson Company obtained a $147,750 4-year 7% installment note from Campbell Bank. We're making annual payments of $43,620 beginning on December 31st. So they want us to prepare that amortization schedule. So in year 1, what's my carrying amount then? Very good. It's the full amount that I owe. The $147,750 is the year 1 carrying amount. Your cash paid, you can put that in for all 4 years. That's the payment amount, the $43,620. So that's the payment we're making every year for 4 years. $43,620. And if you even wanted to go ahead and add it all up, that's $174,480. So $174,480. Okay, so that's always nice. We know that whole column. In year 1, what's my interest expense for year 1? $10,343. Very good. And how did you get that?
I multiplied 147,750 times 0.07.
Very good. Yeah. To calculate our interest, we always take our carrying amount times, in this case, it's an annual payment, so our annual interest rate is 7%. Okay, so for the year one, our interest expense is $10,343. I have to scroll over. So what's my decrease to notes payable? If we paid $10,343 in interest, how much did we pay in principal?
$33,277.
Very good. $33,277. And how'd you get that?
You subtract the note payment minus the interest.
Very good. Yeah, we take our total payment, the note payment, $43,620, minus how much went to interest. So in year one, we're decreasing our note payable by $33,277. And then what's my new carrying amount on the loan? $114,473. Very good. Okay. And again, that's your full carrying amount in January 1, the what, $147,750, minus the decrease in notes payable. So minus the amount that went towards the principal. So $114,473. Well, that becomes our new year two carrying amount. So I just carried that over, $114,473. So year two, $114,473. Still the same cash payment. What's my year two interest? Very good, $8,013. Again, we just took our new carrying amount, the $114,473 times 7%. So then what's our decrease in notes payable? Very good, $35,607. So our cash payment minus the interest. And then we should have a new carrying amount of $78,866. $78,866. And then we just do the same thing for year three. So our new year three carrying amount is $78,866. What's my interest in year three? Very good, $5,521, 5521. So my decrease in notes payable is what, $38,099? $38,099. And then the carrying amount becomes $40,767. $40,767. So the year four carrying amount is at $40,767. Notice they gave you the interest expense in year four. Your decrease in year four should be your carrying amount. You should be paying off, that full carrying amount in year four, because we want our carrying amount to be zero when we're done. So that's kind of how they got the interest. Sometimes the interest gets off by pennies or a dollar in year four. That's why they gave it to you. But in year four, our decrease to notes payable should be the remaining balance, $40,767. So when this note is done, we've made all four payments. We would add up our total interest expense. What's our total interest expense?
$26,730.
Very good, $26,730. And then we could add up the total decrease in notes payable, which should be what? What's our total decrease to notes payable?
The amount that we started off with.
Yeah, very good. You don't even have to do it, right, if you did it right. It's a good check. If you add it all up, it should be your original carrying amount, the $147,750, because we paid off the full principal amount. Okay. So all total for this loan, we paid $174,480 over 4 years. $26,730 of that was in interest, and the rest was the principal amount that we paid off. So yeah, when you're all finished, your total decrease in notes payable should equal the original note amount because we paid it all off. Okay. Any questions on the amortization schedule? Okay, well then we just need to do the journal entries. So for the first one is just the issuance of the note. So what do I debit and credit when the note gets issued? Very good. Cash gets debited and notes payable gets credited for the initial amount, the $147,750. And then in year one, December 31st, when I make my first payment, what do I debit and credit?
Interest payable, it's gonna be cash, interest payable, and notes payable.
You're almost there. Interest expense instead of interest payable. We're going to go ahead and recognize all the interest. So yeah, we're going to debit interest expense, which for year one, the interest was what, the $10,343. So when we make this payment, we debit interest expense. We debit notes payable, the reduction in the principal. So our interest was the $10,343. Our decrease in notes payable was the $33,277. $33,277. And then the cash should be those two added up, which is your cash payment of $43,620. So on December 31st, we made our first payment of $43,620. Of that, interest was the $10,343, and then the reduction in our principal on that note was $33,277. We've already done all the calculations. Now it's just filling in those journal entries. For year two, it's the same format. Interest expense debited, notes payable debited, cash credited. Okay. Your cash is always the same, the $43,620. But then I just looked for year two. Year two interest was $8,013. $8,013. And the principal deduction was $35,607. $35,607. So the structure is the same. You just have to put in the right interest expense and reduction. Same thing for year three. And I'm getting all this from the amortization schedule. So cash is still credited $43,620. Let's see, year three interest expense was $5,521, $5,521. And the note payable was a debit of $38,099, $38,099. And then my last year, again, same structure. Cash is still credited. Interest expense in year four was $28.53. $28.53. And the note payable was $40,767. $40,767. And then part C is the last little question. It said, how will the annual note payment be reported in year one income statement? Well, what account goes on an income statement that we've dealt with in year one? Interest expense. Very good. Out of the year one journal entries, the only one that goes on the income statement, revenues minus expenses, is the interest expense. So the only thing affecting our income statement in year one would be interest expense of the 10,343. That's all it's asking. So you're going to put interest expense, 10,343. Okay. Okay. Any questions on that? Okay. Well, I'm going to show you real quick the Excel spreadsheet just because it's super easy. So if you ever want to set up an amortization schedule, then you can. Okay, it's super easy. I'm going to go out of this.
We use this on the test.
Sure. If you want to take the time to build your amortization schedule, go for it.
It's only 2 seconds time.
Yeah, not that bad. So if I go into Excel, if you're a little familiar with Excel, it's not too bad. The great thing is if you've used Excel before, they have all these templates that are already created for you. So I don't even have to go in and put in formulas. I know how to. I can set up an amortization schedule, but why would I when it's already done for me? So, work smarter, not harder. So if I go File, if I click File and then New, notice it says search for online templates. I can do loan amortization. Let's see, I think this one's a good one. So there's this loan amortization schedule template. I can download it. Notice it already has information in it, but I can change these values and it'll give me my loan amortization schedule. Okay. I know, right? So for fun, I could put in, the problem we just did. So the loan amount was $147,750. We had an annual interest rate of 7%. We only make one payment per year, so loan period in years was actually 4 years. 4 years, one payment per year. We'll put the date at the end of the year. I'll take out that extra payment for now.
That's so nice.
So I just found all the answers to the problem we did without having to do any of the calculations. Isn't Excel great? If you know how to use it. So I didn't really even have to do much. I just typed in the stuff, right? So obviously we rounded the payment to a full amount of $43,620. It has 2 decimals on here, but as you can see, it's pretty close to the same. On ours, our scheduled payment was $43,620. Our principal in the first year was $33,277, and our interest was $10,343. So it was rounded to whole dollars. On our example, we rounded to whole dollars, but it's the same information. Pretty cool, huh? So again, this was on 4 payments. The only thing is when you're doing installment notes, I mentioned it, but when you're doing installment notes, if you change this to a monthly payment, you would need to calculate a monthly interest rate. You would want to take that 7% divided by 12 to get your monthly interest. Otherwise, you're going to have a year's worth of interest every month. Not a good idea. So on here, though, I could just change the number of payments per year to 12, and it gives me my new amortization schedule. So it gives me a new payment amount. It recalculates all of that. It tells me my total interest paid. It tells me everything. The cool thing is, say this was a mortgage. So it was probably more than 4 years, right? Say it's 30 years. So our mortgage every month is $982.98. It tells you our interest and all that. 7% is kind of a high mortgage rate, but we'll go with it for fun. The cool thing is on this template, you can even put in your extra payments. So if you said, you know what, I'm going to pay $200 extra. Right now my total interest is $206,124. If I put $150 each month extra, my total interest drops to $130 $819. And you could kind of scroll down and see how that affects your amortization schedule over time. Trying to go and see the last few payments. We're actually shaving time off of the payments. So we're saving ourselves, what, like $75,000 in interest by paying an extra $150 a month. So, you know, again, it's kind of cool what you can do like pretty quickly. So you could type in your own loan information and say, well, what if I spent, you know, even just $50 extra a month or $25 extra a month, you can see, you know, how many payments you're going to take off and how much total interest you're going to save yourself. That's kind of fun. I do that, you know, again, I've done it with our cars at home to try to make sure and save some interest. Thankfully, it's not a 7% interest rate, but still, you still save money though, and time. So that's kind of fun. If you're comfortable using Excel, you can always use that to calculate your homework. Put in the variables. And you can calculate payments and all of that. It's a payment function in Excel. If you needed to calculate the payment, you can use the PMT function. So it's pretty cool. Any questions on anything in chapter? Yeah, I mean, if you want to create, I'm cool with that. Because as long as you understand, I mean, you have to understand it still, you know, in the test. So absolutely, if you want to create an amortization schedule, and I mean, Excel's just doing the math for you. That's why I love Excel. It's a giant calculator. Very powerful. You just have to know what to tell it to do. I teach Excel, like shameless plug, right? I teach Excel accounting where we go through like a lot of this stuff, pivot tables, everything, fun, formulas, functions, the whole 9 yards. Online, it's an online class. So, any questions? Okay, well, y'all have a great day. And we'll start chapter 11 on Thursday.